Welcome back, investors, to Ticker Time News. I'm Adam, and the stock market actually had a pretty good run this morning. But oh my goodness, let's get into this. There was a 1% gain in the S&P 500 and Dow Jones and the Nasdaq each this morning. But there was a sharp, quick reversal in the afternoon following a Bloomberg TV report. This is it. This is what happened. This is why the market sold off so sharply. 1% up to 1% down. A Bloomberg TV report that Gazprom is going to keep the Nord Stream 1 pipeline shut down due to, quote, a technical issue that involves an oil leak. Surprisingly, there was no timetable provided for when the pipeline might reopen. Now, this Gazprom news came on the heels of G7 members agreeing to impose a price cap on exports of Russian oil. This action is highly sketchy and quickly took over investor mentality. And that's why the market had a huge U-turn today. Now, the morning gains were driven by two factors. Oversold technical conditions that we've been talking about for most of the week, where we're due for a bounce, and a belief that the weaker August employment data, at least compared to July, could be compelling the Fed to take a less aggressive rate hike path. Now, to be completely honest with you, this way of thinking, a less aggressive Fed, because of some report that says the economy is weakening, especially an employment report, it's starting to get a little old. And I've said it before, I'll say it again. The Fed will not pivot in 2022. The Fed has already told us to expect pain and to expect a weaker economic situation. So today's employment report showing weakness compared to last month, well, it wasn't really a surprise. But I'm going to dig into that report here in just a moment. Now, mega cap stocks, they are influential, and they have been. They've been directional drivers for this market. And they were downside drivers in the afternoon trade. But they had plenty of company as a risk-off mentality took root following the Gazprom news. And ahead, of course, of the extended holiday weekend, where history shows us, at least over the last 21 years, that the Tuesday after Labor Day is a bit bearish, with a 57% negative rate. 57% of the time, it is negative the day after Labor Day. So we'll see if that continues to be the path the market wants to take on Tuesday. But looking at my goodness, my thoughts are all jumbled up. Today's market, it caught me off guard. I'll be honest with you. Today's market caught me off guard. Look at the 5-minute time frame right here. We gapped up this morning. We kind of went flat. Is this real? Could this really be the bounce that we're expecting? And then the market kind of takes off for a little bit. And we reach this point, right? It's right around the 4,000 line, just a few points above it, like 4,015, somewhere around there. And the market pauses. Can this really be the bounce that we have all been talking about? But then news starts to hit about this Gazprom situation, Nord Stream 1, and boom, goes the market right back down. But this is interesting. Where we bottomed today, right here, about an hour before the close, is right around that 3,900 mark. Where we heard that number before recently? Well, just yesterday on this live stream. Let me scroll over to show you yesterday. Yesterday's bottom was also right around that 3,900 point level. That is a critical level here for the S&P 500. 3,900, 390 on the SPY. These are important levels right here. Buyers are stepping in at this level. So keep this on your radar for next week, the 3,900 level, okay? If the market can kick off a rally, maybe it's going to kick off from this point, the 3,900. But, my thoughts on the rally. I don't think it's going to last very long. It's not going to be like the summer rally we had. I mean, the next big data is CPI, which I think is around the 13th or so. I'm going to go back to the daily view here on the S&P 500. The ticker symbol is SPX. Let's refresh this chart here so we can see. Now, it is interesting, today the weekly expected move on the lower end was 39.47. Well, we broke below that just barely. And also, this blue line coming up diagonally right here, this blue line. I got to get my highlighter back. Yeah, Bloomberg wrecked it, right? This line right here, this blue line, that also comes in and kind of tags that 3,900 level. So this is a very key level for the SPX, for the SPY, for the S&P 500. Now, if we do get a bounce next week, I don't think we're going very far. Like maybe up to 40, 45 or 405 on the SPY. I think that would probably be a good place to start taking profits if you are going to make a short long position. That's probably a place to take profits. This mark up here, when we get closer to about 4,200, that's the next gap. And I'm not sure if we can rally that far before CPI comes out. We could get a little boost next week, possibly. But like we saw today, headlines can drive these markets lower really quick. Ever since Jackson Hole, this market has been very shaky, right? This big red candle that you see right here. Since Jackson Hole and Jerome Powell coming out and scaring the market, right? Fear the Fed. That's the new saying right now. Fear the Fed. Because the Fed is not your friend right now. And the note that we sent out a little while ago, maybe a couple hours ago, to our investor community on Patreon and Discord, we talked about fearing the Fed and how the market is very jittery right now, and it will not take very much to kick this market, kick the legs right out from underneath it, and this thing to drop fast and hard. Now, the market is overextended on the downside of things, and whenever you're overextended, you can stay overextended for a long period of time, right? Just let's go back and just look at this point right here in history. We always keep pointing it out. Back here, right, where the market just moved sideways. If we look at the RSI, it just stayed elevated there for a while. Now, it was not at an overextended position. It wasn't oversold or overbought. It was kind of just above the halfway line at about 55. Well, now we are down here on the RSI at a 28.6. Now, it could move sideways and we could stay, our relative strength that is, could stay down for a little while as we move sideways. And if we're looking for CPI, again, I think it might be the 13th when that comes out. We're not that many days away from CPI. And are we going to see inflation tick back up a little bit or tick back down? It's just a crazy market right now. And it's a market that is difficult to trade in right now, right? So we just have to be patient. We have to be patient. We have to use common sense. Don't get overextended yourself with going too long or too short at certain levels. But we are finding a little bit of support right here. Could we potentially keep it, bounce from it? I think we can. At least that's what the technicals are saying right now. The technicals right now are saying to me, a bounce is likely in the short term. Longer term, we haven't seen the bottom yet, and that could come by November 1st. So we've got a lot on our plate here. I just find it funny how everything was sunshine and rainbows about a week ago. Now everyone is doom and gloom. Yeah. All right, this is important. Over the past 14 years, the big bull rally that we have just come out of We can go all the way back to 2008, right? Since 2008, you could say we have been in a bull market. Actually, I'm going to put the weekly time frame up here on the chart. Just give it a second to recalibrate that. All right. So the 2008, 2009 bottom in the market. Since that point, and you can see it, it's just above my head. That bottom is right here. Right here. Since that point in time, we have been in a bull market. Now, there have been some corrections and some pullbacks since then, but they've always been a correction or pullback to this 200-day moving average right here. You can see the bounces, boom, a bounce right there. Actually, when we came out of the last financial crisis back there, right here, COVID is the only thing that overshot that, right? So this is a key area for the market, and we have been in a bull market since then. Why? Why have we been in such an extended bull market? The Fed. The Fed has been our friend for nearly 14 years. And it's so hard for market participants to wrap their mind around that the Fed is no longer their friend and that they need to fear the Fed. The Fed would come out when the market is down 10%, the market's down 12%. The Fed comes out, oh, QE, quantitative easing, we'll put liquidity into the market to prop it up. And boom, the market continues to rally. And it continues to rally more. We get to 2000 and the COVID, crash there. And the Fed says, oh, unlimited QE for everyone, right? Yeah. People have gotten complacent, thinking that the Fed is their friend and that the Fed will always step in to save the day. They're not doing that anymore. Do you guys realize that in September, this month, the Fed is offloading $95 billion a month from its balance sheet? That's a big step up from where we have been. Quantitative easing is when the Fed is buying assets, putting money into the market, and they are filling up their balance sheet. We have basically been in QE for 14 years. Now we're in QT, which is quantitative tightening. And that's the Fed offloading their balance sheet, right? Selling those assets to the market, taking liquidity out of the market. What is $95 billion of cash coming out of the market going to do to the market in September? What is $95 billion coming out of the market and onto the Fed's balance sheet going to do to the market in October, in November, in December? This isn't some, well, we're going to do it for a month or two, quantitative tightening, that is. And, and then we'll pivot and we're your friend. Remember, that stuff is in the past, and we've got to retrain our brains, and we have to rethink how the Fed works, what the Fed will do, because the Fed is no longer your friend. Fear the Fed. Go ahead, say it. Fear the Fed. $95 billion coming out of the market. Liquidity drying up. Banks not lending. Banks raising their standards for loans. Interest rates rising. Inflation still hot and heavy. The employment report, that was weaker this time than last time. Sure, 315 or so thousand jobs were added over the last month. Great. I think the employment market is skewed and there's something wrong. There's a missing link. I don't know what it is yet, but there's something not right. Now, if we look at this, you can see that 200-day moving average, it's down here like around, what are we going to call this? 35.50. Easy number to remember. 35.50. Is that where the market's headed? Is my box down here, is that too low, too far away? You know, that yellow little dot that you see here on the screen, which is somewhere around 32.75. Maybe up here at 35.50, maybe that's more like it. Maybe that's where we'll fall to. Maybe. No one's got a crystal ball, so it's really tough to tell. But the Fed is not your friend any longer, and we've got to get that through other market participants. We've got to be able to break through the wall. Okay. All right. Yeah, I went on a little rant there, but, you know, the market's got to face reality, okay? I know you guys understand it completely, but the rest of the market, they need to get a hold of themselves, and they need to have a reality check. And I think a lot of market participants may have woken up to that today, or at least over the past week since Jackson Hole. Okay. So look at the SPY, down 1% today. It was up 1% at its high. The SPY, same thing. Let me open the SPY up, and then I'll do the Qs. Look at the SPY. Same thing. We had a rally this morning, and actually the rally went up to the 50-day moving average, and that's like where it stopped. That was the ceiling for the day for the S&P. It's a 50-day moving average, which is right now sitting on, for the SPY, at about 401. We can break that and get a little rally. Yeah, that 405, I think, is the first target for a bounce. But, yeah. And look at this. It broke to the downside of its weekly expected move. Just barely. The weekly expected move was 394, and then it closed this week at 392. Okay? So a couple points under the weekly expected move. And remember, the options market gets it right 68% of the time. So these are good, what do you want to call them? They're good guidelines. You know, they're good targets to have. They help you to manage risk. All those things. All right, going to the Qs. Let's pull that up. It was down 1.4% to end the day. It fell again, just like the SPX, the SPY, underneath its weekly expected move, but only by a point. The weekly expected move was 296. It closed at 295. So not that far off. Now, I think the Qs, if they could get a momentum from a bounce, because right now, the RSI is at 828. If they could get a little bit of momentum, I think the Qs could reach up here to fill this gap right about 305. So 405 for the SPY, 305 for the Qs. And that would be a nice bounce target, you know, maybe to take a third of it off the table. And then IWM, which are the smaller caps. Not as bad. They were down 0.8% on the day. But they are further outside of their hole than the Qs were. The weekly expected move had the IWM at 182. It closed at 180. So 2 points. 2 points away. And it did today fill that gap that it had opened up 2 days ago when it gapped down. So that is now full. I can take that gap off of here, that gap right there. That also coincided today where it maxed out at. Two things. One, it's 50-day moving average. So now it has closed away from that. But it's 5-day EMA. It raced back up this morning. Tag that 5-day EMA. Tag that 50-day moving average. They are practically together right now. And that's the resistance that the major indices saw today. A lot of the individual stocks, too, they ran up to their 50-day, or they're just now getting down to their 50-day. That 50-day moving average is becoming all too important. You know, the trade setup scans that we do numerous times throughout the week. You know, I try to do it at least 3 to 4 times a week. I'd love to be able to have enough time to get every day of the week, but at least 3 or 4 times a week when we do the numerous trade setups throughout the market. That 50-day one, that one is starting to grow, I guess I should say. And the 200-day one, well, that one had started to shrink. So just something interesting that I noticed there. Okay, let's keep moving on. All right, let me pull up the dollar here and we can see where this is. The dollar broke 109. 109.6 is where it stands right now. So remember what I said. This dollar would have to break that 109 point. Actually, the top right here would be 109.29 or 109.3 to round it up. Today, it got to 109.7. I'm sorry, 109.97. It almost got to 110. Almost, but it didn't. It closed at 109.63, and right now 109.60. Is this the top for the dollar? I mean, it's kind of flagging here at the moment. Maybe if we get a little more momentum on the upside, maybe we could have a symmetrical triangle even starting to form. But either way, the dollar has been racing, right? And when the dollar moves quick, the markets move in the opposite direction almost just as quick. So here's the dollar. It's been looking strong. It was looking strong today. What was that move today? 0.87% gain today in the dollar. That is just crazy. That's just crazy. It's insane. That's a big move for the dollar. It really is. So keep an eye on it. This thing, it could be tapping out on the upside, but it's been strong all year long. Okay, I do want to pull up gold here for just a moment, and then we'll talk about the S&P 500 sectors real quick. Gold. Let's go to GDX right quick. I want to look at this one right here. This is the gold miners. Okay, they've been getting hit really, really hard. There was a little pop right here today. It didn't take them up very high. It took them right about to their 5-day EMA. But gold is something that I think has the potential to make a move here in the short term. So let's get this pulled up out of that volume there. So you can see it pulled up, it tagged that 5-day EMA, which it had been, it was a declining 5-day EMA. Yesterday, it got really far away from it, down 3.1%. Today, it was a nice 3.1% pop to the upside, bringing it right back to that 5-day EMA. Can it break above that? That's the real question here that I'm watching to give us a little short-term possibility on what gold can do. Because I think gold could have, especially if economic numbers continue to look sad, right? And if the market continues to, head down, that's got to give gold a little bit of confidence and possibly have, a little trade there. I'm not saying that it's going to be the next, big mover, but I do think there's potential here for gold and gold miners to move up because they have been beaten down severely. I mean, look at the yearly chart right here. They topped in March. Let me fix this, adjust this real quick. They topped in March, right after the whole Russia invading Ukraine. But then, I mean, they just completely have been getting torn up. So I think there could be a little light here at the end of the tunnel. All right, let's look at those S&P 500 sectors. Not pretty, not pretty. Even though things did look pretty earlier today. Let's lower this down a little bit. You can see There's one green number there. Oh, and then we get another one down there. Okay. So out of the 11 S&P 500 sectors, every single one of them, all of them, reached positive territory. All of them reached positive territory this morning. But then, well, then they just fell. They just fell. And now all but one is in the red. And which one do you think ended up being green today? Energy, of course, right? Energy was green today. XLE is that ticker. Let's pull that up and look here. Energy was up. Oil was up about 0.5%, so not a big move. But energy yesterday was right outside its weekly expected move. Let me get the highlighter up here. So you can see that this is textbook right here. You know, when a product gets outside of the weekly expected move, you've heard me say this a million times now. Typically, it will move back in. And that's exactly what energy did today. It moved back in. Okay. But it did close kind of, right there, just above that weekly expected move. Energy, the weekly expected move was 79.3, and it closed at 79.9. All right, let's look at oil. U.S. oil, easy to remember ticker symbol. Oil, right here, let it load. I think it was about 0.5% that it moved today, which to me was a good thing. It moved 0.7%, so just over 0.5%. This green box here on your screen, this is like a key area for oil, right? It's kind of dipped below that a couple of times where those two highlighted areas are, but it's really holding above like that $85, $86 a barrel. And that was helpful for the energy sector today, with crude oil being up, 0.7%. And it closed at $86 a barrel. Now, moving off of this, going to the Treasury market, U.S. 02Y for the 2-year. The Treasury market had a dynamic session today. The 2-year yield ultimately fell 12 basis points just today. That was a huge pullback. Huge. Look at that. Look at this thing. Look at that red candle today, right? And it closed at 3.4%. It's just a fraction under that in after hours. And then the 10-year US 10Y, the 10-year fell 7 basis points to 3.2%. So we're about 20 or so basis points, about 20 basis points away for the inverted yield to uninvert, right? About 20 points away. So seeing the 2-year fall much further than the 10-year today, that's something that you want to see, because this yield inversion, we want to get out of it. All right, so that's the 10-year and the 2-year. The 10-year has just been a rocket ship. Now, speaking of bonds, I want to look at TLT. Now, that's the 20-year, excuse me there. That's the 20-year Treasury bond ETF. Let's pull this up. I think there could be a medium-term play here. If we are at the end of a business cycle, and I think we are, then when we move into the next phase of this business cycle, where the economy is contracting, the markets are doing poorly, stocks are doing poorly, I should specify that. Stocks are doing poorly, economic indicators are contracting. Bonds do well in that environment, because the economy and stocks are just too uncertain. People want certainty. They want to protect their wealth. Bonds are one way to do that. So I'm keeping a close eye on TLT because I think there could be a possible play here for TLT. You can see here, let me scroll out. This thing has fallen pretty darn hard all of 2022, right? This peak right here on your screen about midway was the 1st of December. That's where this thing peaked. Now, if I go to a weekly view to give you a little more historical context, wow, right? Wow. That was 2020. That was 2020. The double top there, that was 2020. So the bottom over here was December of 2018, right above my head, right here. Okay. My highlighter turned off. Right here was the bottom, right here. That was about 2018. And then it marched higher, right? We get to the bottom right here. And this is January of 2020. And then we move forward. We get to the end of February. We get to March. The big spike right here, that was March of 2020. So when the economy is scary, when the economy is uncertain, that's when people rush over here to TLT. That's why I'm watching it. Because if the economy starts to get scary and look kind of rough, then stocks will underperform TLT. Okay? All right. Let me do this just as a little bit of context, right? Give me one. Let me clean this chart up just a little bit here. I want to put the S&P 500 on here. That's why I'm cleaning the chart up. Okay, come on. Here we go. All right. Now I'm going to switch this from a weekly view to a monthly view to get the full context here. And then I'll put the SPY up here against it. So let's open this up. SPY. Okay. So we've got the SPY on the screen. And we've got TLT. Now, when the economy is doing really well, right? If we go back to, let's say, where it all kind of changed, right here, January of 2012, okay? That's where you see TLT is basically moving sideways right along the weekly expected move that I had there for it. That's where it's at right now. And during this time, what is the SPY doing? Well, the SPY is the orange line. So while TLT is barely moving, the SPY is going up and up and up. Then we get a little movement here right before the 2020 crash. It's almost like somebody knew something over here, right? And then what's the SPY do? It keeps marching on. What does TLT do? It moves sideways. But since the downturn for the SPY, what has TLT done? It's also gone down. Why? Because they didn't believe that there was a recession. So there's no need to rush over here and get into the bond. Get into TLT. There was no reason. Economic data, look good. It's just high inflation. It's just high inflation. The economy is not going to, tank. or go anywhere. That was kind of the thinking. Obviously not for everybody. I mean, we've been talking since January, February about this economy. So let me just take these, clean this chart up here. Okay. Oh, I went one too far. My apologies. My apologies. All right. So you understand what I'm saying there. I think TLT here, that's the ticker, TLT. I think it's been underplayed. And I think it is in a position here where it could start outperforming the SPY. And this is kind of like medium term. I don't know if it's going to start this week. I don't know if it's going to start a month from now. But I do think it will at some point in the short to medium term outperform the SPY, the S&P 500. Why? Simply on the basis that the economy isn't going to be doing so good. And people want to preserve their wealth. And this is where they go. Okay, let's talk about a little data, because we had, one other thing I want to point out on this chart. The other place that was green today on here, this isn't part of the 11 S&P 500 sectors. This is the SPDR, the Spider Gold Trust, okay? And it was barely up, $1.39, which was 0.8%. It was up. Now, I'm bringing this one up because I talked about this one in our trade setups, okay? I talked about this in our trade setup. So I just want to open this chart up a little bit, and I want to show you what I was talking about. If you want to get our trade setups, just click the first link in the description. We do numerous trade setups all week long. Okay, we had the weekly expected moves here for gold. Now, gold got outside of the weekly expected move. It gapped down, and it got to this blue line down here, and that blue line, okay, has held as support before. And not just, going back to July of this year, but if I really squeeze this map together, squeeze this chart together, you'll see at that price point, there were a lot of times that price point acted as support. I mean, the double bottom right here, going back to 2021, that double bottom acted as support at this price point. We can go back to June of 2020, May of 2020. It bounced around, used that as support, and then took off from there. So this is a very key area, and not just recently this year within the past couple of quarters, but for years and years going back, this has always been a support area for gold, okay? So I think there is a strong play here setting up. Is the play guaranteed? No, not a chance. But I do think there's a play. Now, today with it being up 0.8%, almost a full percent, is yesterday it gapped down to this support level. What did it do today? It gapped right back up and closed right on the bottom end of the weekly expected move. The weekly expected move, and this is another reason why the weekly expected moves are so important. It closed at 159.26. The weekly expected move was 159.24. You can't get any closer to that. This has been on the chart since Sunday evening. And here it is Friday evening, and boom. It is 0.0, what is that? 2.02. That's how close it is. And yesterday it had gapped out of it down to support, posted the setup and it bounces, gaps up, doesn't even climb. It just bounces right back up, gaps up to be above that weekly expected move. We're, pretty much right on it. Okay, that's another reason why these weekly expected moves are so important. They can tell you an awful lot. And again, we send these out on 40 different products every Sunday evening to our investor community. Just click the first link in the description and you can get set up there. Okay, let's talk about a little bit of data. The August non-farm payrolls, they increased by 315,000, like I said earlier. Average hourly earnings, they rose a smaller than expected 0.3% month over month. And the unemployment rate also ticked up to 3.7% from 3.5%, as the labor force participation rate also went up to 62.4 from 62.1. Not a big move, but it did tick up. I think the key takeaway from the jobs data that we got today is that the labor market remains in pretty solid shape, at least on paper. It didn't function with the same potency as it had last July, but objectively, there's a disconnect. It's running at a pace that is completely inconsistent with an economy on the brink of a difficult recession. So, like I said earlier in the live stream, there is something off about the labor market jobs report. Something doesn't add up. I don't know what yet, but something doesn't add up. Then we had the factory orders for manufacturing goods. It declined by a full percent month over month in July. And the shipments of manufactured goods also declined by 0.9% after it increased miraculously 0.8% in June. The takeaway here is that this was the first decline in order activity in 10 months. Meaning it could simply be a natural pullback after, an extended period of time of new order increases, as opposed to a meaningful turning point, right? Is this a turning point? Well, as future reports, they're needed to shed better light on this situation. Otherwise, it's just speculation at this point. Now, as a reminder, U.S. equity markets are closed on Monday. So have yourself a wonderful holiday weekend. I'll see you back here Tuesday after the markets have closed. And if you could do me a huge, huge favor, click the like button, share this video with a friend, and if you want our weekly expected moves so you can get it spot on like gold did this week, numerous trade setups throughout the week and using different trading strategies. We use 16 different trading strategies. You can pick which one works best for you, and boom, you have the stocks that you can trade around that strategy. Also, top 10 stocks, weekly expected moves. Today, we just uploaded to our new top 10 list for dividend stocks. When the market goes down, dividends are important, okay? And I also want to say, our Discord server is up and running, and there's a special channel that we put on our Discord server. It's new. The Discord server is evolving as we move through this, brand new phase of it being set up. But today, or maybe it was last night, I can't remember, we added a new channel. And I think it's going to be a very special channel. It's called Time Travel Advice. Yeah, you want advice on time travel? We got it. Actually, it has nothing to do with, how time travel works. But if you went back in time, you today went back in time, What would you tell your younger self about the stock market? What advice would you give your younger self about this stock market? Now, one of our patrons, they posted, and this isn't a private channel. This is one of the public channels, so everyone can participate. But one of our patrons suggested the advice that he would give: don't trade penny stocks. And he gave 2 more tips that he would go back and tell his younger self about the market. So I'll leave you with that one. Don't trade penny stocks. Check out the Discord. You can see the other 2 that were left. It is awesome. I think that space could become even more valuable than the weekly expected moves, the trade setups, all that other jazz. I think this channel could be it could be a gold mine, literally. What advice would you give yourself? So go check it out, post your advice, and I'll see you Tuesday after the market has closed, since Monday the market is closed. And we'll go there. We'll move on from there. How about that? Oh my goodness, it's a rough one. That section is good. Awesome. Super glad to hear that. I think it'll be a fun one for sure. All right, ladies and gentlemen, thank you so very much for joining me today. I greatly appreciate it. Have a wonderful extended break if you're getting one during this holiday weekend. And yeah, we'll be back at it Tuesday for a crazy market. Of course, our investor community and everyone on Discord, I'll see you tomorrow, maybe tonight, and through the weekend and holiday. So take care, and I'll see you in the next video.